Listen, Butters, he's got two dogs in the hunt. He's got the Celtics up there in the NBA, and he's got the Bruins there. So good on you. All right, John, you hear us. We quote your earnings insight blog every Thursday on Market Call. This is a really important one. Why we wanted to have you on live here. We get earnings season really kicked off tomorrow morning or Friday morning, I guess, with a handful of the big banks. And then we kind of get into it over the next couple of weeks. And you've been tracking the negative EPS guidance that we've seen for Q1 2023. We've also been tracking it kind of where, consensus estimates were for S&P earnings for the quarter. They've come down pretty substantially over the last 3 or so months. Talk to us a little bit about what you're seeing here and what we should expect as we get into the meat of earnings season.
Yeah, well, this is definitely one of the more negative quarters we've seen in terms of guidance and estimate revisions. So overall, 78 companies in the S&P 500 gave negative guidance. That was well above the 5-year average of 57, well above the 10-year average of 65. In fact, if it stays at 78, this would be the fourth highest number since we've been tracking the guidance going back to 2006. And same with the estimate revisions. Earnings came down about 6% during the quarter. Again, that was above the 5-year and 10-year average, which was typically about 3%. So as a result, coming at the start of the quarter, we're looking for a very small decline, about 0.3%. Now we're looking for a decline of almost 7%, down negative 6.8%. And if we do see that, that would be the largest decline going back to the pandemic, going back to Q2 20. And it would be the second straight quarter we've seen earnings decline. So a lot of negative sentiment coming into this earnings season for both the companies and from the analysts.
Yeah, and I used historic to talk about the Bruins, and I don't want to be that hyperbolic here, but this is significant. And John, and this is something that Dan and I have been talking about on the back of your work and obviously some of the work that we do, that earnings revisions are coming. Earning estimates are too high. People are too optimistic. And also the multiple that people are paying for stocks in this environment is too rich. So you just look at that 5-year average, 57. Here we are at 78. 10-year average at 65. I mean, even if you broaden it out, and that encompasses a lot of things, we're still seemingly we're at the upper end of things. So, I don't know where we've peaked out at. You could probably speak to that, but my sense is, 78 is a pretty historic number.
Yeah, like we said, fourth highest. And again, you'd have to go back quite a few years. We've peaked around 80. If you go back to, say, 2018, 2019.
I mean, an 80 peak, and here we are at 78.
Yeah, we're not that far away from the peak. Exactly. So, and it's interesting. It's not even, the numbers haven't just come down for this quarter. They've come down for the next few quarters as well. Although it is interesting to note, and we probably get in this slide later on, although numbers have come down for both, for throughout 2023, still looking for growth in the second half of the year. So it'll be really interesting to watch this earnings season, the guidance, the commentary, because you're still looking for that second half recovery. It's lower than where we were a few months ago. You're now just looking at, say, about 2% growth in the third quarter, about 9% growth in the fourth quarter. But they're pretty optimistic out to 2014 too. So again, we'll have to keep an eye out to see what the company commentary is and how much those numbers come down as we go through this earnings season.
John, you've been doing this a long time. And I feel like, this time of year where if companies did not have particularly good visibility and they had just reported a difficult quarter, that they'd usually just take a crack at the full year guidance, right? Like they just take it down a little bit and make it so they can start to beat going forward, right? And I know that you track a lot of the data because once you start getting consecutive beats, that is really tied to better stock performance, right? So sometimes it's kind of just like, kitchen sinking the year or something like that. Thoughts here, because we track your data and I just find it pretty fascinating that, at the start or at the end of December, expectations were for down less than 1%, right? Year over year for Q1. And now they've come down 6.8%, right? Like that's really big. So why are we not seeing bigger whacks to more than just the out quarter guidance?
Well, so interesting on that, we talk about the numbers coming down, then the company's beating. One of the interesting trends we've really seen the last 2 quarters, and we're going to highlight this in Friday's report, is that, sort of the typical way the cycle works is, the numbers come down, companies beat. We see that growth rate usually come up, 3 to 5 percentage points through the earnings season. That's historically the case. But the last 2 earnings seasons, the final growth rate of the quarter is actually finished below the expectations at the start of the quarter. We've seen some pretty significant misses from companies and a number of the large companies these last 2 earnings seasons. And this is really unprecedented. If you go back over the last 40 quarters, we've only had 3 quarters where the final growth rate finished below the expectations at the start of the quarter. And we've had 2 of them in Q4 2022 and Q3 2022. So, there's again a chance that that could happen again this earnings season. Obviously, we'll have to wait to see how it plays out, but there's not a guarantee that we're going to see a smaller loss or any chance, or than this earnings season, because that really hasn't been the trend the last few quarters.
Yeah, let's break it down a little bit by the sectors here. So you're saying at the sector level, 5 sectors are expected to see growth in earnings led by the consumer discretionary and industrials. I think that's kind of interesting, those two groups. And then I want you to talk about the ones that are expected to see declines. But to me, consumer discretionary and industrials are sometimes at opposite sides of the economic spectrum. And so the fact that they're both expecting gains is kind of interesting. Talk to me what you're seeing under the hood here.
Yeah, so what really ties those two sectors together this quarter is travel and leisure. So in the consumer discretionary sector, the hotels, restaurant, and leisure industry is expected to be one of the drivers of growth there, along with Amazon. Amazon had a huge loss last quarter, or a year ago quarter, excuse me. So they're benefiting from some easy comparisons. And on the industrial side, airlines are expected to be the driver of growth again. Take airlines out, and that sector would be reporting a small decline rather than growth of 13%. And then on the flip side, a number of sectors expecting declines. Materials are down, weakness across the board, led by metals and mining. Healthcare, again, weakness across the board, led by biotech and pharmaceuticals. And information technology, weakness there from semiconductors. Although I will say one thing real quick on energy. I know you guys were talking about oil prices earlier in the quarter. Energy is expected to be the third best performer this quarter at 9%, but going forward, it's actually expected to be a detractor to earnings growth rather than a contributor to earnings growth. This is really the last quarter of contribution. So if those prices go up, like you guys were talking about before, we could see energy being a positive contributor to growth through the rest of the year and help boost some of that second half recovery. Although, again, obviously higher oil prices will have a negative impact on some other sectors, but that's certainly something we'll want to keep an eye on this earnings season, where those oil prices go. And do we start to see those estimates for the energy sector start to go higher?
That's a fascinating point that you just make there, because one area, you just said this about industrials, take the airlines out and you have negative growth. Well, today, investors are taking airlines out to the woodshed. American Airlines pre-announced stocks down 8.5%. And then think about what you also just said. Butters is also pretty precedent here, Guy. When you think about how energy or higher input costs could be a drag on other energy, well, that would be a drag on the airlines here. So, Guy, talk to me a little bit about that push and pull here, because again, it really feels like to me that we're already seeing some, I think, really important signs that the economy is weakening fairly dramatically, even as the CPI and some of these inflation readings are coming down.
It's great that we have this, because this goes back to something that I addressed earlier about people saying, if you think there's a recession coming, you can't then think crude oil is going higher. And again, forgetting about the semantics of the entire thing. If you look at this on the one end of the spectrum, that materials is telling you that things are really bad. But energy on the flip side, we're talking about companies now and stocks. Their performance in large part is predicated on the fact that just better run companies. So you can have a thesis, again, my opinion, Dan, that energy can go higher, energy stocks can go higher. And this suggests that to a certain point, and still think the economy is shitty, pardon my French. And that's manifesting itself with the last thing on this list, which is materials. It's really interesting to look at, and you can actually draw those lines, Dan.
Yeah, well, listen, for some of you guys who have those comments about how can one be true and the other at the same time, listen, I want to hear stuff like that. Guy has spelled that out over the last kind of couple months, and it's actually made sense, and it's happening. We're seeing it in the numbers here. All right, John, you alluded to expectations for the full year right now. I think 4 months ago, I think expectations were still for S&P earnings in 2023 to be up mid to high single digits, now expected to be up 1 by year work. And then really soon, as we get into the middle part of the year, towards the end of Q2, early Q3, a lot of investors are going to start thinking about what are expectations for S&P earnings growth in 2024. Talk to us a little bit about what your work is telling us on 23 and 24.
Yeah, so as you mentioned, for 2023, looking for just about 1% growth at this point. And again, that's all second half of the year expected, as we can see in this chart. About 2% growth in Q3, 9% growth in Q4. And we'll have to watch where those revisions come down. And then interesting, 2024, again, a lot, analysts typically are more optimistic the further out we go. That's again the case, looking for about 13% growth in 2014, excuse me. And on a per share basis, we're at about $221 for 2023. But $248 is currently the estimate for 2024. So again, and a significant improvement expected. We'll see how it plays out and how those numbers move this earnings season.
It's interesting. I look at this and it makes sense. A lot of people expecting a back half recovery, and this is anecdotal. Okay. So leave the hate comments at your door. But Taiwan Semi in the fall, if you go back and listen to what they said, and I'm using them as a specific example, they said the first half of 23 is going to be miserable. I'm paraphrasing, but they said they're going to make it up in the back half of 23. And as it turns out, they were trying to buy themselves some time. But just look at what Taiwan Semi said earlier this week. And we had called them on it back in the fall. We said, I don't know in any way, shape, or form how they can have clarity that far out. And it proved to be somewhat correct. So this makes sense in terms of what people are looking for and hoping for. The question is, does it come to fruition? Does it manifest itself, Dan? And obviously, that's the bets that people are making with an S&P here at 41.25.
I don't know about you, Guy, but I have a little scar tissue from past kind of like bear market recessionary periods when analysts start saying, second half loaded, back half loaded. You remember all that sort of stuff? Because oftentimes it never comes to like kind of where they think they are, partially because you see a bigger dip in the near term, and then the, like kind of the, I don't know, coming out of it is a bit harder here.